Knowledge is power. If you know your enemy's location, you can call in an airstrike and bomb them. If you know your enemy's weapons, you can bring counter weapons. If you know your enemy's supply line, you can cut it off. You need to know the enemies that you face so that you can prepare counter strategies. Otherwise, all your soldiers will be wiped out. It's the same when it comes to investing. When investing, you need to know the risks you are taking. Are the risks worth taking or not? Most new investors simply go into the market thinking that they can time the market. They go to war without any knowledge. They think that if they spend all the time with their eyes glued to the stock price and monitoring it, they are able to achieve superior returns. What they did not know is that in the short term, the market is highly unpredictable. In the long term, certain strategies can actually work much better with lesser time and effort. And before you embark on similar market timing strategies, I like to equip you with the knowledge so that you can prepare the best strategy. It's almost impossible to predict when the market is going to crash and when the market is going to pick back up. If you are able to consistently get market timing right, yes, indeed, you are able to achieve outsized return. The key word here is consistency. You may be lucky this year. How about next year and the year after that? If you are able to constantly time the market, great, good for you. Please teach me how. But the chances of doing this consistently and accurately rarely ever happens. Even professionals who spend full time to market timing don't get it right. You often hear analysts saying that the stock market is going to crash. How often do they get it right? What is their percentage accuracy? A broken clock is right 2 times a day. Statistically, it is proven that market timing rarely ever works consistently. It is also statistically shown that time in the market provides greater results than timing the market. In this video, I will show you evidence of attempted market timing by others and how badly they failed. These research are not conducted by me, and I do not claim any credit for the work. I simply summarize them into a video and add fancy footages for your benefit. These research are conducted by reputed academics and institutions. Here, with these evidence, I hope we can rethink our investment strategy and perhaps shift from a short-term market timing approach to something else. Research by Brett M. Barbara and Terence Odin. From young, we are all taught in school that if we work hard, we will strike it rich. If we put in the hours doing work, we will be successful. In general, yes, this is true. But in the investing world, things may turn out quite the opposite. There is this research by Brett M. Barbara and Terence Odin. They studied the trading accounts of 60,000 households from 1991 to 1996. They discovered that households who put in the hard work and spend more time trading in and out of the market earn very little, only 11.4% per annum. Although this is a positive return, we must take note that during this period, the market returned much more. The market returned 17.9% per annum. If we think logically, the act of trading in and out of the market means the investor is putting more hard work and monitoring the market closely to get superior returns. Just like what we are taught in school about hard work. We will think that due to hard work put in by the investor, he should get better returns. But as you can see from this report, this is really the opposite of what we would expect. Hard work does not pay off. In fact, in the investing world, hard work will actually cause underperformance. This underperformance is mainly due to cost of trading and paying for market spread. If they had not paid these commissions, their results would have been similar to investors who did not actively trade. Why then do people trade in and out so often? Are they very happy to pay commissions? The report concluded that these high level of tradings can be at least partially attributed to a simple behavioral bias, and that is, people are overconfident. When there is overconfidence, investors will overestimate the value of their private information. This eventually causes them to trade too actively and consequently to earn below average returns. Research by Charles SCHWAB. Nobody really knows when the next crash is going to be. If right now the market is at all-time high and valuations are all-time high, it would seem logical to sell, right? If you sell out right now, you may miss out on a few more years of potential gain. That would be really wasted. And after you sold out, you eventually need to get back in. If you want to get back in, you have to wait for the market to crash. How do you know exactly when to buy back in? What if you bought back in and prices continue to crash below your buying price? Another consideration is whether to invest one single lump sum right now or dollar cost average. If you invest one lump sum, you put money into the market in one single big lump sum once a year, regardless of price. If you invest using the dollar cost average method, you put in consistent amount of cash every month into the market, regardless of price. So given these different investing methods, which is more superior? The investment brokerage firm SCHWAB ran the numbers from 1993 to 2012, and this is what they found. If you lump sum invest and put in 2,000 into the market every year on the first trading day of the year, your returns will be 135k. If you dollar cost average every month, you divide 2,000 into 12 equal portions and put them into the market every month, you also get 135k. This research shows that lump sum investing and dollar cost averaging strategies give very similar results. Between these two strategies, dollar cost averaging is the better strategy compared to yearly lump sum, because most of us receive our paycheck every month from our jobs. Our monthly salary cash inflow can match the money investment contributions. Secondly, it prevents procrastination. Some of us just have a hard time getting started. We know that we should be investing, but never quite get around to it. Mostly, this is due to fear of the risk involved. Another advantage of dollar cost averaging is that it also minimizes buying regret. This is because the investor consistently makes multiple small investments. Regardless of market condition, it will eliminate the temptation to try market timing strategies that rarely succeed. The SCHWAB research also had another very interesting insight. If you compare two investors, the first investor has really bad luck. He invests lump sum at the worst possible highest price every year, and we have a second investor who is afraid of market losses. He chose to buy something really safe, like treasury bills, which is short-term government debt that matures in less than 1 year. So every year, he will put $2,000 into T-bills. Now, between these two investors, who do you think will end up wealthier? At first glance, it seems like the investor who invested at market highs will not do very well. He might even have made some losses. To our surprise, the first investor actually made around 120k, while the second investor only made 44k. These two results had significant difference. The stock market investor with bad timing made 3 times more than the risk-averse investor. To ensure these findings are robust, SCHWAB conducted similar research across different time periods. They analyzed all 76 rolling 20-year periods dating back to 1926. In 66 of the 76 periods, the results were roughly the same. It also must be noted that in about half of the instances, bad timing does underperform the investor who bought T-bills. So there isn't anything we can do if you try to time the market and your luck is really bad. If you have really bad luck and always buy at the market peak year after year, it's better for you not to time the market at all. You can still participate in the market using the dollar cost average method. Conclusion. So in conclusion, according to the Brad M. Barbara and Terence Odin's research, the more you trade, the worse your results are going to be. Actively monitoring and trading the market is unlikely to improve your performance. The gross results are going to be roughly the same as compared to if you did not actively trade. But the net result is that you will perform worse because your profits will be eaten by commission and trading fees. Secondly, according to SCHWAB's research, lump sum investing, where you invest a lump of cash every year, will do just as well as dollar cost averaging investing, where you invest money dollars into the market. Even though the results are roughly the same, dollar cost averaging is superior because of several reasons. Firstly, it allows you to match the cash flow from your monthly income. Secondly, it is easier for new investors because it stops procrastination. And lastly, when you are investing just small sums of cash, it minimizes your buying regret. And lastly, SCHWAB's research also highlighted that even if you really have bad luck in the market and buy in yearly at the market highs, you could still be better off than someone who does not participate in the market at all. Exceptions. Now, these methods are great, but before you wholesale copy and paste these research results into your investment strategy, we need to be cautious on a few points. Firstly, these research are done on past results. They are using past observations in the past to try best predict future events. There's nothing wrong with using this method. In general, it's quite a reliable method, and I don't think there are any other better methods out there. We all have been using past observations to predict future events in our daily lives. If you experience 4 seasons in a year for the past hundreds of years, you know that going forward, the next year is almost 100% guaranteed to experience the same 4 seasons again at roughly the same time of the year. The thing is that past results are by no means a guarantee of future results. So be cautious to understand that these results are simply reflections of the past. Nobody can predict what we will get moving forward. Secondly, these research use statistics to measure certain performances. In statistics, we measure probabilities, not certainties. When Brett M. Barbara and Terence O'Dean's research stated that active traders only achieve 11.4 annual returns, it must be well noted that this 11.4% number is only an average number. Some traders might achieve 50% annual returns, while others might achieve negative 40%. And if you average them all out, it works out to be 14.1%. So you see here, there is always a range of uncertainty around the average. Thirdly, the research by Charles Schwab built a very compelling case for dollar cost averaging strategy. They compared the results to the S&P 500 index. As we all know, on hindsight, the S&P 500 is on a long-term perpetual bull market since 1920s. In between, there are periods of bear market, but in the long run, it's a bull market. It is very convenient of this research to pick the strong performing S&P 500 as a benchmark to build a case. What about other benchmarks? This is a Singapore Straits Times Index benchmark. As you can see, it doesn't perform as well as the S&P 500. It goes through periods of ups and downs. The same thing goes for the Japan Nikkei 225. It crashed from the peak in 1989 and has not fully recovered since. So, before you incorporate these strategies, understand the caveats involved and set your expectations right. Agree or disagree with the video? Subscribe, leave a like, and comment down below. And I'll see you in the next video.